Let's think about what's coming up in markets. Talk about the markets in 3 minutes then, Mark. And we'll begin on the jobs report as we approach this first big data point, I suppose, of the year. What are you looking out for?
I think that there's a couple of perspectives on this jobs data. So one is, our colleague John Arthur has done this piece kind of saying, look, the participation in this jobs data is so low nowadays that it's providing less information. That's dangerous because it lets people open up to kind of either dismiss it if it doesn't suit their view and gives it more kind of volatility and erraticness. On the flip side, Anna Wong, chief US economist for Bloomberg, who's generally been exceptionally over the last couple of years in calling the cycle much better than average out of economists out there. She has always maintained that she thought that US would go into recession around the turn of the year. And she's saying, look, actually the jobs data out there is indicating we might already be in recession. And she's talking about how some of the cyclical indicators, the most cyclical sectors of the economy are already seeing job losses at a rate which would indicate around the start of a recession or just before the start of a recession. So I think that's a very interesting dynamic today that I'm going to be watching for.
OK, so cyclical sectors and job losses there, looking for further evidence of that, perhaps. I'm thinking about market positioning going into the jobs report as well. Interesting story on the Bloomberg terminal talking about one large options trade that's targeting a yield as high as 4.15%. We're around 4% on the 10-year right now. So clearly somebody expecting yields to pop a lot higher here. What do you think about positioning on that front ahead of this jobs report?
I mean, we've still got a Fed which is only promising 3 rate cuts this year and doesn't want to promise more aggressive than that anytime soon, and is unlikely to until we get to March, which means that unless the data starts validating the aggressive pricing of which was close to 6 cuts being priced only a few days ago, unless data starts validating that soon, the natural convergence over time will be those rate hikes to slowly get priced out. So it makes sense that the skew is much more asymmetrically set up for a bigger yield bounce than for a yields fall, because the market has already bought into the idea of an extremely aggressive Fed pivot, and much more than the Fed themselves are promising.
OK, so that's interesting. Yeah, there was such an aggressive buy-in to that Fed pivot view that we got post the last Fed meeting, wasn't there, back in December of last year. Mark, are you nervous about a lack of participation in markets or a lack of volume in markets on a day where we're getting an important data print? And I say this because there are plenty of signals. My favourite is, low number of unread emails in my inbox when I get up early in the morning. There are plenty of signals that not everybody is back at their desks just yet.
No, that's definitely the case. Look, I always hated non-farm payrolls. When I was trading, it used to be my worst day of the year. As I got more senior, I learned the idea is that actually just to go away from non-farm payrolls and come back a few hours later to then make the assessment, because the price action afterwards is always terrible. So yes, if I was a trading seat today, I'd be absolutely dreading it because there is low participation. We're skewed for a market that really could move quite dramatically either way. And I think there's a lot of uncertainty about what the theme is for the rest of January. Fortunately, I'm not in that trading seat anymore.